Ever feel like you're just getting whipsawed by the financial markets? You know, one minute it's all euphoria, the next it's total panic. It really can feel like this random emotional roller coaster. But what if there's a pattern under all that chaos? What if you could get an edge just by understanding the predictable rhythm of market cycles? Well, that's exactly what we're going to dig into, a framework that can help you turn that chaos into a real strategic advantage.
You know, when Warren Buffett talks, pretty much everyone in finance listens. So who does he listen to? Howard Marks. That's a heck of an endorsement, right? And that's why, for this explainer, we're going to use Marks's brilliant book, Mastering the Market Cycle, as our guide to help us all get a more disciplined and insightful approach to investing.
So, here's the game plan. We're going to start with the psychology that's really behind all the market swings. Then we'll map out the different phases of the cycle, learn how to, take the temperature of where we are right now, and finally figure out how to use all that knowledge to strategically position our own portfolios.
Okay, first things first. Market cycles are not driven by some super complex math or secret Wall Street formulas. Nope, they're driven by something way more predictable, actually. Human psychology. And the best way to think about that is with a simple pendulum.
And this right here, this image just nails it. The pendulum of investor feeling, it almost never just sits there in the middle, all calm and rational. Instead, it's constantly being pushed by greed and fear, swinging like crazy between these two extremes. One day, investors see nothing but clear skies ahead. The next, they're convinced the world is ending.
Right, so market downturns aren't just random accidents. They are the unavoidable hangover from the wild party of the boom that came before. The seeds of every bust are always sown in the crazy optimism of the good times. It's not chaos, it's just cause and effect, and it happens over and over and over again. Okay, so if the market is just this big repeating pattern of boom and bust, what does that journey actually look like? Let's try to map out the predictable phases of a typical cycle.
This is basically our map. Now, every cycle is a little different causes, different timelines, but this underlying pattern, this oscillation around a central trend line, is remarkably dependable. It's kind of like that old saying, history doesn't repeat itself, but it sure does rhyme. Well, this is the rhyme.
And we can break that journey down into these distinct stages. It always kicks off with a shaky recovery from an extreme low, which then builds steam into a full-on upward swing. After it hits that euphoric high, a correction is bound to start, which leads to a downward swing and a new low. And at that point, guess what? The whole process is ready to start all over again.
And listen, this right here is maybe the most important thing to get. Markets don't go from undervalued to fairly valued and just stop. No way. The momentum, all that optimism and greed that fuels the recovery, it carries that pendulum right past the middle and deep into overvalued territory. It always overshoots.
All right, so we've got the map, but how in the world do we figure out where we are on it right now? This is where we shift gears from theory to a really practical tool for checking out the market's current state. It's time to take its temperature.
The good news is that these extremes, they're usually not very subtle. At a market top, the signs are all over the place. Everyone's euphoric, getting a loan is a piece of cake, prices are through the roof, and so is the risk. And at the bottom, it's the exact opposite. Everyone is miserable. Credit has dried up. Prices are in the gutter, and it feels like there's risk everywhere, even if the actual risk is pretty low.
This checklist is our thermometer, and to use it, you literally just have to look and listen to the world around you. Are lenders throwing money at people, or are they scared to lend? Is the general mood in the news positive or negative? Are people celebrating aggressive risk-taking, or is caution the word of the day?
And the advice that comes with it, it's just brutally simple and incredibly effective. If you look at your list and realize you're checking off most of the boxes in that market top column on the left, yeah, it's time to get extremely cautious. The party is probably getting close to its end.
Okay, so knowing the temperature is step one. Step two is actually adjusting the thermostat on your own portfolio. This is where we take what we've observed and turn it into a real strategy for dialing our risk up or down based on where we are in the cycle.
See, every single investor is stuck in this constant tug-of-war between two opposing risks. If you want zero risk of losing money, well, you're definitely going to miss out on opportunities. And if you chase every single opportunity, you're opening yourself up to some major losses. The real art is in balancing them, and knowing the cycle tells us when to lean one way or the other. So let's start with what normal looks like. Think of this curve as our baseline. When the market cycle is somewhere in the middle, the potential for gains and losses is pretty balanced. This is the normal state of things, where the odds aren't really tilted strongly one way or the other.
But let's say your thermometer is telling you the market is cold, that we're near a bottom. That's when the odds shift in our favor. This is the time to be more aggressive. And notice what happens. This doesn't change the market itself, but it shifts our own potential outcomes, tilting our personal probability curve towards much higher returns.
And on the flip side, when that checklist is screaming market top, we do the exact opposite. We shift to a defensive stance. This visual shows perfectly how we can protect ourselves. By cutting back on risk, we're basically chopping off that nasty tail end of potential catastrophic losses, which gives us a much more favorable set of outcomes, even if the market starts to fall.
All right, so let's tie this all together. The art of mastering the cycle is really about using that checklist to read the environment, and then using that read to adjust your portfolio between being aggressive and being defensive, all to get the odds on your side.
Now, I gotta be honest, this all sounds pretty simple, but actually doing it, that's the hard part. As the legendary investor Sir John Templeton said, this strategy requires real discipline and courage to go directly against what the rest of the crowd is doing.
And let's be super clear about something. This whole framework is not about having a crystal ball. Nobody, and I mean nobody, can predict exactly what the market is going to do tomorrow. This is about something so much more powerful. It's about preparation. By understanding where we are today, we can prepare for what's most likely to happen next and tilt the long-term odds in our favor.
So ultimately, it's all about a shift in your mindset. Instead of asking, what's going to happen, you start asking, what is happening now and how should I position myself for it? The goal isn't to predict, but to prepare. Which leaves just one question left. What are you preparing for?